Hello and welcome. In this explainer, we're going to tackle a really important topic for your exams, the bank reconciliation statement. We'll break it down into simple, easy to understand pieces so you can feel confident you've mastered it. So let's start with a really common situation. You look at your company's records, the cash book, and it says you have $1,500. But then you get the statement from the bank, the passbook, and it says you have $1,760. So why are they different? The tool we use to figure that out is the Bank Reconciliation Statement, or BRS for short. Here's how we're going to break it all down today. First, we'll cover the key terms and concepts you absolutely need to know. Then we'll dig into why those balances are different in the first place. After that, we'll get into some comparisons and special alerts for your multiple choice questions. We'll practice with some exam questions, and finally, we'll wrap it all up with a high-yield summary. Okay, first things first. We have to build a solid foundation. Let's make sure we're all on the same page with these key terms. Understanding these is essential. First up is the cash book. The best way to think about this is that it's your company's own diary for its bank account. Every bit of money that comes in, every bit of money that goes out, it gets written down here. This is your side of the story. Now, the passbook, which you probably know as a bank statement, is the bank's version of events. It's their official record of your account. So it's showing the same transactions, but from their point of view. This is the bank side of the story. A favorable balance is a good thing. It just means you have money in the bank. But here's the tricky part, and this is super important for your exams. In your cash book, this is a debit balance. Why? Because cash is an asset to you. But from the bank's perspective, that money is a liability. It's something they owe you. So they record it as a credit balance. They're opposites. On the flip side, we have an unfavorable balance, also called an overdraft. This happens when you've spent more money than you actually had. In your cash book, this is shown as a credit balance because now it's a liability. You owe that money to the bank. So the big question is, why do these two records, your cash book and the bank's passbook, so often show different numbers? Well, let's look at the main reasons why this happens. Most of the time, the differences come down to two things: timing and information. For example, maybe you've issued a check to someone, but they haven't cashed it yet. Or you've deposited a check, but the bank is still processing it. Those are timing differences. Other times, the bank knows something you don't yet, like a customer paid you directly, or the bank took out a service fee. And, sometimes it's just a simple mistake made by you or the bank. Okay, let's move on to a section that is absolutely critical for your multiple choice exams. We're going to compare some of these concepts side by side and point out some common traps you need to watch out for. This slide perfectly shows that mirror image relationship we just talked about. See how it works? When the balance is favorable, money in the bank, it's a debit for you but a credit for the bank. And when it's an unfavorable overdraft, it's the complete opposite, a credit for you and a debit for the bank. Really understanding this flip in perspective is the key to getting a lot of exam questions right. All right, here is your first big MCQ alert. You'll want to remember this. Here's a simple trick. From the bank's point of view, a credit to your account is good for you. It means more money is coming in. But a debit from the bank is bad for you. It means money is going out. This way of thinking is a common source of confusion, making it a perfect exam trap. And this table here clarifies two more terms that people often mix up. Unpresented checks are checks you've written, but the other person hasn't taken them to the bank yet. Uncredited checks are checks you've received and deposited, but the funds haven't cleared yet. Notice that both of these are just about timing. All right, theory is great, but let's see how you do with some real practice. We're going to walk through a couple of exam-style questions to really test your knowledge. Okay, here's your first question. In the cash book, a favorable balance indicates what? Is it A, credit balance, B, debit balance, C, bank overdraft, or D, adjusted balance? Take a second to think it over. If you said B, debit balance, you are absolutely correct. So let's break down why B is the right answer. A favorable balance means you have cash, and cash is an asset to your business. In accounting, assets are recorded as a debit balance. So A is wrong because a credit balance means an overdraft. C is just another name for an unfavorable balance. And D, the adjusted balance, is the final number you get after you finish the reconciliation. Let's try one more. This one is all about getting the terminology right. Unpresented checks are also referred to as what? A, bounced checks, B, outstanding checks, C, uncredited checks, or D, uncollected checks. And the correct answer here is B, outstanding checks. Let's look at why that's correct. The terms outstanding and unpresented mean the exact same thing. You've issued a check, but it's still out there. It hasn't been presented to the bank for payment yet. A bounced check is something totally different. That's when there's not enough money to cover it. And C and D, uncredited or uncollected checks, refer to money coming in, not money going out. Okay, to finish up, let's do a very quick review of the most important points. If you only have time to memorize a few things for your exam, make it what's on this next slide. So let's run through it one last time. A BRS just explains the difference between your books and the bank's. A favorable balance is a debit in your cash book. An overdraft is a credit. You need to know the synonyms. Unpresented means outstanding, and uncredited means uncollected. And finally, remember that things like bank charges or direct deposits are common reasons for the balances to not match up at first. And that brings us to the end. We've spent our time talking about how to reconcile past transactions. But I want to leave you with one final thought to consider. How does this whole process of looking backward actually help a business control its money today and make smarter plans for the future?